Hello, this is Dr. Phil Rosenkrantz again with EGR403 Online. We're winding down to the last few chapters. Now we're going to be talking about Chapter 10. The subject is depreciation. Let's go to slide number 2, our big picture. We're at the point now where we're going to be refining our analysis. We've talked about different methods, but up to this point we've only been talking about before tax cash flows. Now we're going to bring into consideration, depreciation and taxes, and some other things. So let's go to slide number 3, talking about depreciation. It's very important for tax purposes. And what depreciation is it's a systematic way of allocating the cost of an asset over its useful life or depreciable life. Let's go to slide number 4. There are several different ways to look at depreciation. There's the economic context and the accounting context. But they're both essentially allocating the cost of an asset over some period of time because you're using it up, it's becoming obsolete, and then also you want to take into account that expense for tax purposes. So let's go to slide number 5 and look at the expense side of it. If you'll recall from our discussion of accounting, we talked about the concept of expenses where we would subtract for tax purposes, accounting purposes, the cost of labor and utilities and materials and insurance as expenses. And then we also said we have items that last more than 1 year, so we can't count those as expenses in 1 year. We have to spread that out, and that's where the depreciation comes in. So when we do that for things like machinery, we would include the installation costs, and if we're buying a piece of property, we would depreciate the building or any improvements to it. Let's go to slide number 6. The depreciable life is the period over which we're going to allocate the asset and recover the expense, and that's determined in various ways that will be explained later. Depreciation isn't an actual expense in a year in the same sense as if you were paying for labor and materials. You did have to purchase something up front, in which case you either paid cash for it and it's paid for. So the depreciation expense doesn't come up year after year, but you had to fork out a big chunk in the first year. The other place that it comes in is if you got a loan for it and you're paying off the loan, and so you're going to have the interest expense on the loan, and so that's deductible. But it's not a traditional expense like all the others, and it's deducted from revenue, and then because you're doing that, it's going to produce some tax savings, and that tax savings gives you a cash flow. So depreciation generates cash flow. Let's go to slide number 7. If you are using an asset for business purposes, and if it's lasts more than 1 year and it wears out, then you can depreciate it. Let's go to slide number 8. Property is classified several ways, tangible and intangible, and in the tangible category we have real and personal property. Real property are things like land and buildings. That's where you get the word real estate from. Personal property are things like equipment, furnishings, vehicles, office machinery. And those are what we are concerned with many times as engineers, is we're buying new equipment, or we're trying to justify the expense of new equipment or new machinery or new processes. And if you're in the field of industrial engineering or civil engineering or manufacturing engineering, you may be justifying the expense of buildings or additions or things like that. Let's go to slide number 9. The historical depreciation methods are straight lines, sum of the year's digits, declining balance, and declining balance with conversion to straight line. Those methods, we are still teaching those because they show up on the EIT exam, and they are the basis for the current depreciation methods that are used. However, we don't get into as much depth as we used to in teaching these methods. So we're going to cover those. And then we're going to cover what's called Modified Accelerated Cost Recovery System, or MACRS, which is currently in use in our current tax system. So we'll cover all those, but keep in mind that it's MACRS that is currently in use. So let's go to slide number 10. We're going to set up an example, and we're going to use that example to illustrate some of the historical methods. In our example, we're purchasing an asset for $900. It's going to have a useful life of 5 years, and at the end of the 5 years, we're estimating the salvage value to be $70. The cost basis of our investment is $900, and if we had some installation expenses, those would be included. The salvage value is an estimate, and it's typically, if we're using a salvage value, based on some rationale or accounting practices and procedures. So those are going to be our numbers for our example. Let's go to slide number 11, and we're going to start with straight line depreciation. It's the simplest one. We simply take the cost basis, we subtract the salvage value, and that's how much we're going to depreciate over the useful life. We divide that by the number of years, n, and we get a flat rate that we're going to depreciate every year. So in this example, it's pretty straightforward. 900 minus 70 divided by 5 years gives us $166 a year. And if you go to slide number 12, you see a graph, and the graph shows that the original book value of the equipment, $900, is reduced every year by the amount you depreciate, $166, and so the book value goes down each year until it gets down to $70. And so this is a typical straight line depreciation type scenario. So let's go to slide number 13. Slide number 13, we're talking here about accelerated depreciation methods. Those are the ones that are coming up from now on. In the accelerated depreciation, we deduct more of the depreciation at the beginning of the depreciable life and less at the end. We're still only deducting about the same total amount, but we're doing more at the beginning. The advantage of that is that we get more tax savings at the beginning of the project. And those early tax savings give us more cash flow, and that's more money for us to use and for us to invest. And that goes along with a basic principle of the time value of money that we've learned, and that is that money now is better than money later. So accelerated depreciation is a good thing for the company. It's desirable. And so those laws that created accelerated depreciation were partly put in there as an incentive for companies to purchase new equipment so that they could get the tax advantages. And the government liked that because it stimulated the economy. It encouraged companies to invest in new equipment. You'll find that the tax laws are designed in many cases to stimulate the economy or to direct investing to particular sectors of the economy that the government wants to support. Let's go to slide number 14 and look at our first accelerated depreciation method, which is called the sum of the years digits method, or SOYD. With this method, we take the number of years in our depreciable life and we add up the digits, and that gives us the numerator of a fraction, and then we take the number of years left of the depreciable life, we put that in the numerator, and then that gives us a fraction of the depreciable amount that we take each year. So for example, if n is equal to 5, then the sum of the year's digits is 5 plus 4 plus 3 plus 2 plus 1, or 15. So the first year we have 5 years left, so 5/15ths of our depreciable amount is how much we're going to depreciate. So 5/15ths of our depreciable amount is $277. So the first year we're depreciating $277. The next year it's $221, and then it goes down from there. Now you'll notice that in the third year, that on slide number 15, if you look at that depreciation schedule, you'll notice that in the third year, that's $166. That's the same as the straight line amount. And the total amount that's depreciated over 5 years is the same as with straight line, but you get to deduct more early. And go to slide number 16, and there's a picture of it. And with accelerated depreciation, you see that the graph isn't a straight line, but it's a nice decreasing slope. And then it curves to somewhere near the salvage value. So anyway, that's the sum of the year's digits method. Let's go to slide number 17 and look at the double declining balance method. With the double declining balance method, what we do is we divide by n the number 2. That's where the 2 or the doubling comes from. And so in this case, if n is equal to 5, then that would be 2/5. And we multiply that by the book value that's left. And that becomes our depreciation amount for the year. And so each year we subtract how much we've depreciated to get the new book value, and we multiply that by, in this case, 2/5 and get the next depreciation amount. So let's take a look at that calculation. Let's go to slide number 18, and you'll see that we start out with 2/5 of 900 gives us $360 depreciation. Well, that's more than the 277 we had with SOYD depreciation, and it's a lot more than the 166 we had with the straight line. So we get 360 the first year. We subtract that from our book value, and it means we have a new book value of 540. So the next year, our depreciation is 2/5 of 540, or $216. Now we subtract that from our book value, and we get a new book value, and then we go on and on. If you go to the next slide, slide number 19, you can see a graph of our double declining balance, and it's even steeper at the beginning than with some of the year's digits. And in this case, it happens to end up right at $70, but as I'll point out later, that doesn't necessarily end up that way. But anyway, this is our double declining balance method. Let me go to slide number 20, and we'll talk about that condition where at the end of the double declining balance we don't hit the exact salvage value that we had in the previous examples. We basically have three things that can happen with double declining balance. We can, first of all, over depreciate, and that's where the curve comes down and comes out below the salvage value. If we do sell it at the salvage value, then we treat that difference as a gain, and that affects our taxes at the end of our useful life. I'll talk about that later on. Or we could hit exactly, which is what we did in our example. But sometimes we under depreciate, and that's where at the end of n years we never did get down to the salvage value. Well, we don't like that, because that means that we had some depreciation we could have taken that would have sheltered some of our income from taxes. And so we missed out on some savings from taxes that we could have taken earlier. Well, what the government allows is what's called conversion to straight line in the most favorable year. And if you see that your accelerated depreciation is going to come out too high, you can convert somewhere along the line to straight line for the rest of the depreciable life and depreciate straight down to the salvage value. And that's called conversion to straight line. And so that saves you some money. So you'll see how we treat that later on. in the MACRS situation. Okay, let's go to slide number 21. Of these methods we've looked at so far, the double declining balance is preferred, especially if you can convert to straight line. And that's where we're at so far. But now let's go on to slide number 22 and talk about MACRS. This is the Modified Accelerated Cost Recovery System. It's currently in use, and it's a kind of a cookbook approach to depreciation. First, you determine what the cost is of your item. Second, you determine what property class it's in. Then from that, you go to a table that tells you what percent to depreciate each year. And you multiply that percent times your initial cost, and that gives you your depreciation for the year. Now you'll notice that we multiply that percent times the initial cost. We're not multiplying by the book value or the before tax cash flow or anything else. We're only multiplying it by the first cost of the product. So let's go to slide number 23. The reason that MACRS came about was there was a lot of going back and forth between tax accountants and the IRS about what were the useful lives of products, of assets. Of course, business wanted to depreciate things faster to get the tax benefits, and the government was discouraging that because they wanted the taxes. Also, companies would say that items had very low salvage values because they wanted to depreciate them further, and the IRS would fight it because they wanted more tax revenue. And with all of that, finally, the Congress passed this law which kind of provided a cookbook approach. But the cookbook approach does give a lot of advantages to businesses. It basically adopted double declining balance with conversion to straight line in the most favorable year as the tax method. And what it also does is it assumes that the investment, that the purchase of the asset happens in the middle of the year. That's because companies used to like to buy stuff at the end of the year and claim it for the whole year. So the government compromised with this mid-year convention, it's called. So let's see how this works. Let's go to slide number 24. First thing you do is you determine the property class. I've only copied part of the table, but you look down the table until you find the description of the asset that you purchased. And then that tells you whether you're in the 3, the 5, or the 7, whatever property class you're in. So let's say that you have some special tools for the finished plastics industry. Well, that's a 3-year property class, etc. You look it up and see what class you're in. Now, for automobiles, there's a special way that that's treated, and that footnote isn't shown on your transparency or on your slide. But anyway, that's the first thing you do. Pretty simple. Let's go to slide number 25. Well, there's the rest of the property classes, but we're going to go ahead and move on to slide number 26. And once you determine your property class, then you look at the column and that corresponds to that, and it tells you what percentage of the first cost of the asset that you deduct for each year's depreciation amount. And it converts to straight line in the years where the asterisk is shown, just to kind of let you know that. So it's pretty straightforward. For example, your 5-year property class, if you spent $100,000 for a piece of equipment, 20% of $100,000 is $20,000, so $20,000 is your first year's depreciation. So it's pretty straightforward. Let's go to slide number 27. We're getting down to the end here on our discussion of depreciation. We need to talk about that end of the depreciable life situation, though, where we have the gain or loss on the sale of an asset. Because when it gets down to the end of the useful life, we're done using that item, we're going to dispose of it. We're going to sell it, or we're going to sell it for scrap, or we're going to throw it away, but we're going to do something with it. We have 3 cases that we're going to be concerned about. and because they affect our taxes. Go to slide number 28. Here's our first case. This is where, at the end of the useful life, we sold the item for a salvage value at a market value that was above our ending book value. Well, the government says that you had depreciated it down to $5,000 book value, but you sold that asset for $7,000. They want to treat that as a $2,000 profit. And so you have to pay taxes on that $2,000. And they call that depreciation recapture. And you pay ordinary income tax on that profit, on that gain. Let's go to slide number 29. Here's a situation where our book value was $5,000, but we only sold it for $2,000. So we took a loss on that asset of $3,000. So now that loss is reflected in our profit, and it saves us the taxes on $3,000. So we treat that as a loss. Then finally, we have another situation on slide 30. And here we actually sold the item at a market value much higher than what we originally paid, and much, much higher than our book value, because we had been depreciating it. Well, how can this happen? Well, you purchased some property with a building on it. You depreciated the building, but when you went and sold it, it had gone up in value because of land prices going up and appreciating. Well, the amount above your initial cost is treated as a capital gain, and the amount above your book value up to your original cost is treated as depreciation recapture. And those may or may not have the same tax rate, but then you'd have to pay taxes on both of those. Well, anyway, that's a brief look at depreciation. I tried to go as fast as I could, but if you didn't understand something, you need to just go back, look in the chapter, look at the slides again, take a few minutes and look at some examples, because it's fairly technical in a few cases and you may not have picked it up the first time through. Anyway, thank you, and see you in the next session. Bye.